Sometimes booms and sometimes it doesn't. And you have to live your life through both episodes, because we just keep swimming, and sometimes the tide is with us and sometimes against, but we keep swimming either way. If I were 25 years old in 2026, the first thing I'd do is ignore about 95% of what passes for investment advice today. Most of it is designed to make the advisor rich, not you. The financial services industry has perfected the art of selling complexity because complexity justifies fees. They want you confused. A confused customer is a profitable customer. I'd start with something so obvious it sounds stupid. I'd spend less than I earn, not 5% less, not 10% less, substantially less, maybe 30 or 40% less if I could manage it. This sounds impossible to young people today because they've been sold a lifestyle they can't afford by advertisers who profit from their debt. But it's not impossible. It just requires saying no to things that don't matter. The difference between spending 90% of your income and spending 60% is the difference between financial stress and financial freedom. That 30% gap, compounded over decades, is the gap between retiring broke and retiring wealthy. But nobody wants to hear this because it means sacrifice. It means driving a worse car than your neighbor. It means living in a smaller apartment. It means skipping the vacation everyone else is taking. People would rather be comfortable now and desperate later. I'd rather be slightly uncomfortable now and free later. Once I had money to invest, and this is critical, I wouldn't do anything with it immediately. I'd sit on it. I'd read. I'd study. I'd learn what the hell I was actually doing before I started doing it. Most people do the opposite. They get some money and immediately start trading because sitting still feels like wasting time. It's not. Sitting still while you learn is the highest return activity in investing. Every mistake you avoid by learning first saves you more money than most good investments make you. The education you get from reading Berkshire annual reports, reading about past market bubbles, reading about how businesses actually work, that education compounds forever. The money you lose making stupid mistakes because you were too impatient to learn first, that's gone forever. So if I were starting in 2026, I'd spend my first 6 months reading everything I could find about how businesses work, how markets work, and most importantly, how human psychology works in markets. Because markets aren't really about companies and earnings. They're about human beings making decisions based on greed and fear. If you understand the psychology, you understand the market. If you only understand the math, you'll get killed. Here's what I'd read. I'd read every Berkshire Hathaway annual report from 1977 to present. Not skim them. Read them carefully. And think about what Warren is actually saying. I'd read Ben Graham's Intelligent Investor, not because his specific methods still work exactly as written, but because the principles are eternal. I'd read books about market history. Manias, Panics and Crashes, Devil Take the Hindmost, books that show you how the same patterns repeat forever because human nature doesn't change. I'd read biographies of successful investors and successful business people, not to copy what they did, but to understand how they thought. The tactics change, but the thinking process doesn't. And I'd read annual reports of actual companies, boring companies, utility companies, insurance companies, banks. I'd read them until I understood how they make money, where the risks are, what matters, and what doesn't. This is free education. You don't need to go to business school. You just need to read and think. After 6 months of reading, I'd have a pretty good sense of what I'm doing. At that point, I'd make my first investment decision, and it would disappoint everyone looking for excitement. I'd put 80% of my money into a low-cost S&P 500 index fund. Just park it there and forget about it. Why? Because I know something that most people don't want to accept. I'm probably not going to beat the market. Neither are you. Neither is almost anyone. The statistics are brutal on this. Over any meaningful time period,
Something like 90% of professional investors fail to beat a simple index fund. These are people who do this for a living, who have teams of analysts, who have access to company management, who spend 60 hours a week studying markets. 90% of them lose to the index. So what are the odds that you or I, doing this part-time while holding down a job, are going to beat them? Close to zero. This is painful for smart people to accept because smart people think they're above average at everything. But in investing, being smart isn't enough. Being smart can actually hurt you because you overthink things. You see complexities that don't matter. You convince yourself you've found an edge when you haven't. The index fund is humbling. It says you're not special. You're not going to outwit the market. You're just going to capture market returns, which over long periods are excellent. About 10% annually if history is any guide. That turns into generational wealth if you're patient. But patience is exactly what people lack. They put money in an index fund, watch it go nowhere for 6 months, get bored, and start day trading. Then they lose money and blame the market. The market didn't fail them. Their temperament failed them. So 80% goes into an index fund with the explicit understanding that I'm not touching it for decades. It's gone. It's dead to me. I don't check the price. I don't care if it goes up or down. It's accumulating shares, and those shares are compounding, and in 40 years I'll have more money than I know what to do with. That leaves 20% to play with. And here's where it gets interesting. With that 20%, I'd do something that 99% of investors never do. I'd wait. I'd just sit there with cash, reading and learning and watching, waiting for something obvious to appear. Not something clever, not something complicated, something obvious. What do I mean by obvious? I mean a situation where a good business is selling for substantially less than it's worth for reasons that don't make sense. This doesn't happen often. Most of the time, markets are reasonably efficient. Good businesses trade at fair prices. Bad businesses trade at cheap prices for good reasons. You can spend years looking and not find anything compelling. That's fine. Sitting and waiting costs nothing. But maybe once every couple of years, something breaks. There's a market panic and everything gets sold regardless of quality. Or there's a scandal at a great company that doesn't actually affect the business fundamentals. Or there's a regulatory change that everyone misunderstands. These are the moments where patient capital makes generational returns. In 2026, I'd be watching for exactly these kinds of situations. I don't know what they'll be because they're unpredictable by definition. But I know they'll happen because they always happen. Human beings panic. They overreact. They sell first and think later. When that happens, I want to have cash available to buy what they're dumping. Let me give you a hypothetical example of what I'd be looking for. Let's say there's a scandal at a major bank. The CEO lied about something. The stock drops 40%. Everyone is screaming that the bank is going to fail. The media is writing obituaries. Now, 99 times out of 100, the market is right to panic. The bank really is in trouble. But maybe this is the one time where you dig into the actual financials and realize the scandal doesn't affect the bank's ability to make money. The deposits are still there. The loans are still performing. The capital ratios are still strong. The market is punishing the stock because of headline risk, not business risk. That's an opportunity. That's when I'd take some of that 20% cash and buy the stock that everyone else is dumping. Then I'd wait. Maybe it takes 6 months for people to calm down and realize the bank is fine. Maybe it takes 2 years. Doesn't matter. I know the business is sound and I bought it cheap. Eventually, the market figures it out and the stock recovers. That's how you make real money. Not by being clever, but by being rational when everyone else is panicking. But here's the critical part. I'd only do this when it's obvious. When the math is clear, when I understand the business well enough to know that the market is wrong. If there's any doubt, I'd pass. I'd rather sit in cash for years waiting for the perfect opportunity than force mediocre opportunities just to feel like I'm doing something. This is the opposite of how most people invest. Most people feel compelled to have an opinion on everything. They're constantly trading, constantly active, because being idle feels like failure. But in investing, activity is usually the enemy of returns. The more you trade, the more mistakes you make. The more mistakes you make, the poorer you get. I'd also be very conscious of what I don't understand. Technology is a perfect example. Everyone in 2026 is going to be screaming about AI stocks, quantum computing stocks, whatever the hot sector is, and maybe some of those companies will do well, but I don't understand how they work. I don't understand their competitive dynamics. I don't understand how to value them. So I'm not going to invest in them, no matter how much money everyone else is making. This will make me look stupid for a while. People will brag about their AI stock gains, and I'll be sitting there with my boring index fund and my cash. But I've seen this movie before. In 1999, everyone was getting rich on internet stocks that I didn't understand and didn't invest in. People thought I was an idiot for missing it. Then 2000 happened, and those people lost everything while I still had my capital. I'll take looking stupid temporarily over being actually stupid permanently. Another thing I'd be obsessive about in 2026 is avoiding debt. This is going to sound extreme, but I'd avoid debt almost entirely. No car loans, no credit card debt, no margin loans. Nothing. The only debt I might consider is a mortgage on a house I plan to live in for decades, and even then I'd put down a massive down payment and keep the payment well below what I can afford. Why am I so paranoid about debt? Because debt is the thing that kills you when markets crash. When you have no debt, a market crash is just a temporary inconvenience. You might lose paper wealth, but you're not forced to sell anything. You can sit tight and wait for the recovery. When you have debt, a market crash becomes an existential threat. If you're leveraged and your assets decline in value, you get margin calls. You're forced to sell at the worst possible time. You lock in losses that could have been temporary. I've watched this destroy people over and over. Smart people, rich people, people who had it all figured out until the market turned against them and their leverage became a noose. There's a saying in poker that applies perfectly to investing. You can't go broke taking a profit, but you can absolutely go broke trying to get rich quick. Debt is how you try to get rich quick. No debt is how you actually get rich slowly. So in 2026, I'd be living in a modest place, driving a modest car, and sitting on cash while everyone else is leveraging up to buy whatever's hot. I'll look boring. I'll look like I'm not participating in the wealth creation, but I'm playing a different game. I'm playing the survival game. The people who are leveraged and excited and making huge gains, most of them won't survive the next crash. I will. And after the crash, when they're broke or close to it, I'll have capital to deploy at crisis prices. That's when generational wealth gets made, not in the boom times when everyone is greedy, in the bust times when everyone is terrified. Let me tell you what else I'd avoid in 2026. I'd avoid anything that smells like speculation disguised as investment. Crypto probably still exists in some form in 2026. Maybe it's more legitimate by then, maybe it's not. Doesn't matter. I don't understand what gives it value, so I'm not buying it. Same with SPACs if those are still around. Same with meme stocks. Same with whatever new financial instrument Wall Street invents to separate fools from their money. The test I'd use is simple. Can I explain to a reasonably intelligent person exactly how this thing makes money? Not how the price might go up, but how it generates actual cash flow. If I can't explain that, I'm not investing. A share of Coca-Cola makes money because people buy Coca-Cola and the company keeps some of the revenue as profit. Simple. A rental property makes money because tenants pay rent, and some of that rent is profit after expenses. Simple. Bitcoin makes money because, well, it doesn't make money. It just sits there hoping someone will pay more for it later. That's not investing, that's speculation. Maybe I miss out on some gains. Probably I do. But I also avoid the catastrophic losses that wipe out speculators when the music stops. I'd rather make 10% a year for 40 years than make 100% one year and lose 90% the next. Consistency beats volatility. Now let me talk about something people don't think about enough: taxes. In 2026, I'd be obsessive about tax-advantaged accounts. Every dollar I can put in a 401k or IRA or whatever the current equivalents are, I'm maxing those out. Why? Because the math is incredible. You get to invest pre-tax dollars, which means you're investing more money than you'd otherwise have. That money compounds tax-free for decades. By the time you're 65, the difference between investing in a taxable account and investing in a tax-advantaged account is enormous. We're talking hundreds of thousands of dollars on a middle-class salary, but most people don't max out their retirement accounts. They contribute enough to get the company match and then stop because they want the rest of the money now for spending. This is insane. They're giving up free money from the employer match, and they're giving up decades of tax-free compounding just so they can buy stuff they don't need. If I'm young in 2026, every single dollar goes into tax-advantaged accounts before I spend a penny on anything discretionary. The tax code is one of the few advantages regular people have over the wealthy. Wealthy people have to pay capital gains taxes and income taxes on everything. Middle-class people can shelter significant amounts of money in retirement accounts. It's stupid not to use that advantage to its fullest. Another thing I'd think about constantly is inflation. By 2026, we've probably been through a few more inflation cycles. Maybe inflation is high, maybe it's low, doesn't matter. The principle is the same. Cash is trash over the long term. If you hold cash for decades, inflation destroys it. This is why you have to own productive assets. Stocks represent ownership in businesses that can raise prices when inflation hits. Real estate generates rents that rise with inflation. Bonds are trickier, and I'd mostly avoid them at my age because the returns don't justify the risk in most environments. But the key point is you cannot just save cash and expect to build wealth. Inflation is a silent thief. It takes a little bit every year, and over decades it takes most of it. People don't feel this theft happening because prices rise gradually. But look at what a dollar bought 50 years ago versus today. It's devastating. The only defense is owning things that grow in value faster than inflation. Good businesses do this. They raise prices, they become more efficient, they compound value. That's why stock ownership over the long term is essentially the only path to wealth for people who aren't born rich. You might ask, what about real estate? Real estate can be good, but it's tricky. If I'm young in 2026, I'm not rushing to buy property. The conventional wisdom is you should buy a house as soon as possible because it's an investment. That's partially true, but mostly marketing from the real estate industry. A house you live in is not really an investment. It's a consumption item that might appreciate. You have to live somewhere, so you're not really getting investment returns. You're getting a place to live that might be worth more later. Maybe it is, maybe it isn't. Meanwhile, you're paying property taxes, maintenance, insurance, and opportunity cost on the down payment. It might work out well, or you might end up underwater if you buy at the wrong time. I'd be very careful about real estate in 2026. If prices have been going up for years, I'd assume I'm near a top and I'd rent instead. If there's been a crash and everyone is terrified of real estate, then maybe I'd buy. But I'd only buy a modest place with a huge down payment that I could easily afford even if I lost my job. No stretch purchases. No counting on appreciation. I'd buy it as a place to live, not as an investment, and if it appreciates, that's a bonus. The real estate to consider for pure investment is rental property, but that's a whole different animal. It's not passive. It's a business. You're a landlord. You deal with tenants, repairs, vacancies, all kinds of headaches. If you're good at it and you have the temperament for it, rental property can generate excellent returns. But most people are terrible landlords and lose money. So unless I had a real interest in being a landlord and I was willing to learn the business properly, I'd skip it and stick to stocks. Let me tell you what I'd be reading every day in 2026. Financial statements, not news articles, not analyst reports, not Twitter or whatever the equivalent is, actual financial statements. I'd pick companies that interest me and I'd read their 10Ks. All of them. Every page. Most people can't do this because they find it boring. Good. That means less competition. Financial statements tell you everything you need to know about whether a business is good or bad. Is revenue growing? Are margins expanding or contracting? How much debt do they have? How much cash are they generating? What are they doing with that cash? Are they buying back stock, paying dividends, reinvesting in growth, or wasting it on stupid acquisitions? You can figure all of this out from the filings. It takes time and it's tedious, but it's free and it works. Compare that to listening to CNBC, where some talking head gives you his opinion based on nothing. Financial statements are facts. Opinions are noise. I'd take facts over noise every single time. I'd also be studying mental models and thinking frameworks. This is something almost nobody does, but it's incredibly valuable. Charlie Munger, that's me. Talking about myself in third person feels strange, but bear with me. I've spent my whole life collecting mental models from different disciplines. Psychology, physics, biology, mathematics, history. Each field has useful ways of thinking that apply to investing. For example, the psychology of human misjudgment. There are dozens of cognitive biases that make people do stupid things with money. If you understand these biases, you can avoid them in yourself and exploit them in others. When everyone is panicking because of loss aversion, you can be the calm one buying assets cheap. When everyone is overconfident because of recency bias, you can be the cautious one sitting in cash. Or take the concept of margin of safety from engineering. Engineers design bridges to hold 10 times the expected load because they know their calculations might be wrong. Investors should do the same thing. Don't buy a stock that's fairly valued based on your assumptions. Buy it when it's trading at a significant discount to your estimate of value so that even if you're wrong, you probably don't lose money. These mental models compound like interest. Every model you learn makes you slightly better at thinking. Over decades, you become a significantly better thinker than people who never studied this stuff. And in investing, being a better thinker is the only sustainable edge. Here's something else I'd do in 2026 that will sound strange. I'd actively cultivate relationships with people who are smarter than me and who think about money rationally, not people who are getting rich quick, not people who are constantly trading and bragging about gains, people who are patient, rational, and focused on the long term. These people are rare. Most people interested in investing are either gamblers or salesmen. The gamblers want to talk about their wins and ignore their losses. The salesmen want to sell you something. Neither group is useful. But occasionally, you meet someone who actually thinks clearly about capital allocation and long-term value creation. When you find those people, stay close to them. Have conversations. Share ideas. Challenge each other's thinking. Warren Buffett and I did this for decades, and it made both of us better investors. You don't need to find another Warren Buffett. You just need to find a few people who are rational and curious and willing to admit when they're wrong. Those conversations are worth more than any book or course because they're dynamic. They expose your blind spots. They challenge your assumptions. They keep you honest. At the same time, I'd ruthlessly avoid people who are going to make me dumber, people who are constantly panicking, people who chase fads, people who think they can time the market, people who are envious of others' success. These people are poison. They'll infect you with their bad thinking and you'll make worse decisions. I've seen it happen 1,000 times. A rational person starts hanging around day traders or crypto bros or whatever the current mania is, and within 6 months that rational person is making the same mistakes everyone else is making. Environment matters. If you surround yourself with patient, rational, long-term thinkers, you'll become more patient, rational, and long-term. If you surround yourself with gamblers and fools, you'll become a gambling fool. Choose your environment carefully. Now let me address something that's going to be a huge temptation in 2026. Social media and financial influencers. By 2026, there are probably thousands of people on various platforms telling you how to get rich. They have big followings. They post screenshots of gains. They promise they can teach you their system. Ignore all of them, every single one. Here's why. People who are actually good at investing don't spend their time making videos or posting on social media. They're busy investing. The people making content are making money from the content, not from investing. They're selling courses, affiliate links, ad revenue, whatever. Their business model is attention, not returns. This creates a terrible incentive structure. To get attention, they have to be entertaining and exciting. Boring advice doesn't get clicks, so they tell you about options trading, penny stocks, day trading, crypto, whatever is exciting. They show you their winners and hide their losers. They make it look easy and fun. It's all a lie. Not a deliberate lie necessarily, but a lie nonetheless. Investing is not exciting. It's boring. It's reading financial statements and waiting. That doesn't make good content, so the influencers don't talk about it. If you follow their advice, you'll lose money. Maybe not immediately, but over time the math catches up with you. The commissions, the taxes, the mistakes, they all add up. Meanwhile, the influencer makes money whether you win or lose, because they're selling attention, not returns. So in 2026, I'd delete whatever the popular social media apps are, or at least I'd never use them for financial advice. They're designed to make you feel like you're missing out, like everyone else is getting rich while you're standing still. That feeling is poison. It makes you take risks you shouldn't take. It makes you chase things you don't understand. The best investors I know don't use social media at all. They read books, they read financial statements, and they think. That's it. No Twitter, no YouTube, no TikTok, none of it. Just quiet, patient study. That's the path to wealth. Let me talk about something painful now. Mistakes. If I'm starting in 2026, I'm going to make mistakes. Everyone does. The question is, how big are the mistakes and do you learn from them? The way to keep mistakes small is position sizing. This is something most people get completely wrong. They find an investment they like and they put half their money in it because they're so confident. Then they're wrong and they've lost half their wealth. Stupid. The right way to do it is to never bet so much on any single thing that being wrong destroys you. Even if you're very confident, even if you've done all the analysis and it looks perfect, you still might be wrong. The world is messy and unpredictable. So you size your positions assuming you might be wrong. For me, that means no single position is more than 10 or 15% of my portfolio, and that's only if I'm very confident. Most positions would be 5% or less. This feels like you're not really committing, like you're not backing your conviction, but it's actually the smartest thing you can do. It means you can be wrong multiple times without going broke. You can learn from mistakes without losing everything. Compare that to someone who bets big, gets lucky once or twice, feels like a genius, then bets even bigger and loses everything. I've watched this pattern destroy so many people. They make money, They attribute it to skill rather than luck. They increase their risk, and eventually they blow up. The ones who survive are the ones who stay humble, who size positions carefully, who assume they might be wrong even when they feel certain. When I do make a mistake, and I will, the key is to recognize it quickly and cut the loss. Don't hold on to a bad investment hoping it comes back. Don't average down on something that's declining unless you've done new analysis and you're even more confident than before. Usually, when something goes down after you buy it, it's because you were wrong about something. The market is telling you something. Listen to it. This is psychologically very hard. Admitting you were wrong feels bad. Selling at a loss feels like failure. But it's not failure, it's learning. Every mistake you acknowledge and learn from makes you a better investor. Every mistake you deny and hold on to makes you a worse investor. I'd rather take a small loss and move on than hold a bad investment for years hoping to break even. Let me tell you what I'd be thinking about market cycles in 2026. By that point, we've probably had another recession or two since 2024. Maybe we're in one in 2026. Maybe we just had one. Maybe one is coming. Doesn't matter. The key is understanding that recessions are normal and crashes are buying opportunities. Most people get this backwards. When markets crash, they panic and sell. When markets are high, they feel confident and buy. They're doing exactly the wrong thing at exactly the wrong time. If I'm investing in 2026 and markets are near all-time highs and everyone is optimistic and talking about how stocks only go up, that's when I'm cautious. That's when I'm holding extra cash. That's when I'm not finding many opportunities. Conversely, if markets just crashed, if everyone is terrified, if the news is all doom and gloom, that's when I'm looking for things to buy. That's when great businesses go on sale. That's when patient capital makes the best returns. This is simple in theory, but almost impossible in practice because human psychology fights against it. When everyone is scared, you feel scared too. When everyone is greedy, you feel greedy too. You're wired to follow the herd. Overcoming that wiring requires discipline and experience. The experience part is hard because you have to live through a few cycles before you internalize the pattern. But the discipline part you can work on now. You can make rules for yourself. When the market drops 30%, I'll invest X amount of my cash reserves. When the market is up 50% from the lows and valuation ratios are stretched, I'll build cash reserves. Having rules helps because it removes emotion from the decision. You're not trying to figure out what to do in the moment when your emotions are running hot. You decided ahead of time what you do, and now you just execute. This won't make you perfect, but it will keep you from making the worst mistakes. Here's what I'd tell myself about retirement accounts and time horizon in 2026. If I'm 25, I have 40 years until traditional retirement age. 40 years is an eternity in markets. It's enough time to weather multiple crashes, multiple recessions, multiple periods of terrible returns. It's also enough time for compounding to turn modest sums into substantial wealth. The math is simple but powerful. If you invest $10,000 at age 25 and it compounds at 10% annually, by age 65 you have $450,000. If you invest $10,000 every year from 25 to 65 at 10%, you have $4.8 million. That's on a middle-class salary, just saving $10,000 a year. This is why time is your biggest advantage when you're young. You don't need to hit home runs. You don't need to find the next Amazon. You just need to consistently save money, invest it in productive assets, and let time do the work. But most people squander this advantage. They don't start investing until they're 35 or 40. They waste their 20s spending everything they earn. By the time they realize they should be investing, they've lost a decade of compounding. That decade costs them millions of dollars. If I'm 25 in 2026, I'm treating every dollar I invest as a dollar that's going to compound for 40 years. That completely changes how you think about money. $100 spent on something stupid isn't just $100 gone. It's $100 that could have become $4,000. That's the real cost. Opportunity cost is the most important concept in investing, and most people never think about it. They only count the money they lose, not the money they could have made. If you count opportunity cost, the cost of not investing when you're young is staggering. Let me talk about diversification because there's a lot of confusion about this. People hear they should diversify, and they take it to mean they should own 100 different stocks. That's not diversification, that's diversification. You're spreading yourself so thin that you can't possibly know what you own. If something goes wrong with company number 73 in your portfolio, you probably won't even notice. Real diversification is about owning assets that don't all go up and down together. Stocks, bonds, maybe some real estate, maybe some cash, different asset classes that respond differently to different economic conditions. For most people, especially young people, the right level of diversification is pretty simple. Own a broad stock index fund that gives you exposure to hundreds of companies across different sectors. That's diversified enough. You don't need to own bonds when you're young because you have decades to recover from stock market crashes. You don't need to own gold or commodities or alternative investments. Just own stocks through an index fund and you're fine. The only time I'd diversify beyond that is if I had specific investments where I'd done the work and I understood the business well enough to justify a concentrated position. But even then, I'd never have more than 20 or 30% of my money outside the index fund. The index fund is my anchor. It's the safe, boring, reliable part of the portfolio that I know will do fine over the long term. Everything else is me trying to do slightly better, and I might be wrong, so I keep those bets small. Here's something else I'd think about in 2026. Health. This sounds unrelated to investing, but it's not. Your health is your primary asset. If you're sick, if you're tired, if you're stressed, you make bad decisions. You can't think clearly. You take shortcuts. You miss important details. Every successful long-term investor I know takes care of themselves. They exercise. They sleep enough. They manage stress. They don't work 100-hour weeks trying to get rich quick. They work sustainable hours and they take care of their bodies and minds. This pays off in better decisions over decades. Compare that to someone who burns themselves out at 30, who sacrifices their health for their career, who's constantly stressed and exhausted. That person makes worse decisions. They're more impulsive. They're more emotional. They chase quick fixes. Their judgment deteriorates. So if I'm starting in 2026, I'm making time for exercise. I'm sleeping 7 or 8 hours a night. I'm eating reasonably well, not because I'm trying to live forever, but because I want my brain working properly when I'm making financial decisions. A clear mind is worth more than any investment tip. Let me be very direct about something. If you're reading this in 2026, hoping I'm going to tell you what stocks to buy, you've missed the point. I don't know what stocks to buy in 2026. I don't know what the market will do. I don't know which sectors will perform well. Nobody knows these things, and anyone who claims to know is lying or deluded. What I know is principles. Spend less than you earn. Avoid debt. Own productive assets. Be patient. Don't panic when markets crash. Don't get greedy when markets boom. Learn continuously. Admit mistakes. Think for yourself. These principles worked in 1926. They worked in 1976. They'll work in 2026. And they'll work in 2076. They work because they're based on arithmetic and human psychology, neither of which changes. If you follow these principles, you'll probably do fine. Not spectacular, not exciting, just fine.